Meet Bill and Karen. They live in Tennessee. Both turned 66 last year. Bill worked as a hospital maintenance supervisor. Karen taught third grade for 32 years. They are not rich. They never earned six figures. They were savers. Last April, they filed their tax return. Their income for the year was $95,000. $40,000 came from Social Security. The rest came from their investments. And they owed the IRS exactly $0. Not 100, not 50. Zero. Bill thought it was a mistake. He called their tax preparer 3 times. It wasn't a mistake. It was the tax code working exactly as written. Today, I'll show you how they did it and how you can copy it with $3,500 a month in tax-free retirement income. This is not a loophole, not offshore, not aggressive tax planning. It's a mainstream piece of the U.S. tax code that most investors have never been told about. By the end of this video, you'll know the 2 funds Bill and Karen used, which account each fund goes into, and the exact portfolio size you'd need to copy their result. And the part most people miss is this. There's one number that makes this work, and it's not $98,900 like most financial articles tell you. It's a much bigger number, and I'll show you what it is in just a moment. Quick note, I'm not a financial advisor or a government employee. Everything here is for educational purposes only. For your specific situation, always check with a qualified professional. All right, let's get into it. The number nobody talks about. Here's what most people think. They hear tax-free investment income, and they assume it's some kind of trick. It isn't. It's a rule called the 0% qualified dividend bracket. Here's how it works. When you own a quality stock long enough, the dividends it pays you are called qualified dividends. Qualified dividends get special tax treatment. They are taxed at 0, 15, or 20%, never at your ordinary income rate. And in 2026, a married couple filing jointly pays 0 federal tax on qualified dividends, as long as their taxable income stays under $98,900. Now, here's where it gets interesting. That $98,900 is not your total income. It's your taxable income. Taxable income is what's left after your deductions come off. For Bill and Karen, both age 66, the deductions stack up fast. Start with the standard deduction for a married couple. That's $32,200 in 2026. Then add the age 65 bonus. That's another $1,650 each, so $3,300 more. Then add something brand new. It's called the senior bonus deduction. Congress passed it in 2025. It gives each spouse over 65 another $6,000, so $12,000 more for the couple. Add it all up, $32,200 plus $3,300 plus $12,000. Bill and Karen can shield $47,500 before a single dollar of tax is even calculated. So the real ceiling for a 65-plus couple isn't $98,900. It's $98,900 plus $47,500. That's up to $146,400 in qualified dividends before the IRS takes a penny. Here's the identity of a smart retiree. They know the number that matters is not the one in the headlines, it's the one after the deductions stack. So now you know the ceiling is much higher than you thought. But there's a catch. A silent formula from 1993 can drag income you thought was safe right into the danger zone. Let me show you. The Social Security tax torpedo. Here's the myth. Most retirees believe Social Security is tax-free once they start claiming it. Here's the truth. Up to 85% of your Social Security can be taxed, depending on your other income. The IRS uses a formula called provisional income. It adds up your adjusted gross income plus any tax-free interest plus half of your Social Security. If that number goes over $32,000 for a married couple, Social Security starts getting taxed. Over $44,000, up to 85% of it becomes taxable. And here's the painful part. Those thresholds haven't changed since 1993, not once. So every time you add investment income to your retirement plan, you risk pulling more Social Security into the tax pile. For some retirees, this creates a hidden marginal rate of over 40%. Every extra dollar of dividends drags 85 cents of Social Security into taxable income with it. This is the Social Security tax torpedo. It wrecks a lot of retirement plans quietly, without the retiree ever seeing it coming. But here's the escape hatch, and this is the part Bill and Karen figured out. The IRS provisional income formula does not see Roth IRA money at all. A qualified Roth distribution is not part of your adjusted gross income. It doesn't show up in provisional income. It doesn't show up in taxable income. It's completely invisible. That means every dollar you pull from a Roth sidesteps the torpedo. It doesn't push your Social Security into the tax zone. It doesn't raise your Medicare premiums. It doesn't count anywhere. It is, and this is not an exaggeration, the most powerful account the IRS allows ordinary Americans to use. Here's the identity. Smart retirees don't just think about what to invest in, they think about which account to invest from. Before I show you the two funds that make this whole strategy work, I want to hear from you. Drop a comment right now. Do you hold your Dividend ETFs in a Roth IRA, in a taxable account, or both? I read every single comment, and it helps me tailor future videos to what you actually need. All right, now let's look at Bill and Karen's exact two-fund playbook. Two funds, two accounts, zero tax. Bill and Karen used two ETFs, just two. Most retirees overcomplicate this part. The first is SCHD. That's the Schwab U.S. Dividend Equity ETF. SCHD holds about 100 of America's strongest dividend-paying companies: Coca-Cola, Home Depot, Pepsi, Verizon. It yields about 3.4% a year. Not flashy, not exciting, but here's the magic. Historically, close to 100% of SCHD's dividends are qualified. That means they get the 0% tax treatment when you keep your taxable income under that ceiling. That's why Bill and Karen put SCHD in their regular taxable brokerage account. In a taxable account, the qualified dividend treatment actually matters. The second ETF is JEPI. That's the JP Morgan Equity Premium Income ETF. JEPI does something different. It holds quality stocks and sells covered calls on the S&P 500 to generate monthly income. It pays about 8% a year. Big number, sounds great on the surface, but here's the catch. About 83% of JEPI's distributions are not qualified. They're ordinary income. In a taxable account, JEPI yield gets taxed at your regular income rate. That can eat 20% or more of your yield right off the top. So where does JEPI go? Inside a Roth IRA, every single time. Because inside a Roth, the tax classification doesn't matter. Ordinary income, qualified dividends, capital gains, it's all tax-free coming out. JEPI in a Roth gives you 8% yield with zero federal tax, ever. Here's the mistake most retirees make. They put SCHD in the Roth and JEPI in the taxable account. That gets the strategy exactly rapside. You're wasting SCHD's qualified dividend treatment and you're handing JEPI's ordinary income straight to the IRS. Now let's do the math on Bill and Karen's portfolio. They put $305,000 of JEPI in their Roth IRA. At 8% yield, that generates about $2,100 a month. They put $490,000 of SCHD in their taxable account. At 3.4%, that generates about $1,400 a month. Total monthly income, $3,500, tax-free at the federal level. Their combined portfolio, about $795,000. Not $2 million, not $3 million, under $800,000. So now you know the strategy, but I'd be doing you a disservice if I stopped here, because there are 4 silent traps that can unravel the whole plan, and almost nobody on YouTube is telling you about them. The 4 traps that break it. Trap 1. State income tax. Bill and Karen live in Tennessee. Tennessee has no state income tax on dividends, so their federal zero stays a true zero. But if you live in California, Oregon, New Jersey, or New York, your state does not offer a 0% rate on qualified dividends. They tax dividends as regular income. So a couple in California running this exact strategy could still owe $2,000 or $3,000 in state tax every year. The federal part is still zero. The state part is not. Trap 2. Medicare IRMA. IRMA is the Medicare surcharge for higher income retirees. And here's the trap most people miss. Dividends that are taxed at 0% federally still count toward your Medicare income calculation. That's because IRMA uses a different number called Modified Adjusted Gross Income. Your qualified dividends are in there, even when they're taxed at 0%. For most retirees, this isn't a problem. But if you also do a large Roth conversion, or sell a business, or realize a big capital gain, it can push you over an IRMA threshold. And that surcharge can cost an extra $6,000 a year per couple. Trap 3. The widow's cliff. When a spouse passes away, the surviving partner has to file as single the following year, and the single filer thresholds are almost cut in half. The 0% qualified dividend ceiling drops from $98,900 to about $49,450. The standard deduction drops. The Social Security thresholds don't move, but they bite harder because you only have one benefit now. A strategy that worked perfectly for both spouses can suddenly generate a tax bill the year after one passes. Smart retirees plan for this. They don't pretend the tax code treats widows kindly, because it doesn't. Trap 4. The 2028 sunset. That $6,000 senior bonus I told you about in Chapter 2, it's not permanent. It's in place for 2025, 2026, 2027, and 2028. After that, it expires unless Congress votes to renew it. If it goes away, Bill and Karen's deduction stack drops by $12,000. Their tax-free ceiling comes down with it. That doesn't break the strategy, but it means you plan with a buffer, not right up against the line. So now you know the 4 traps. Here's what smart retirees do with this information. Your move. Let's bring it home. Bill and Karen didn't do anything fancy. They didn't use trusts. They didn't move their money offshore. They didn't hire a celebrity tax firm. They did 3 simple things. They held qualified dividend ETFs in their taxable account. They held high-yield ordinary income ETFs in their Roth IRA. And they watched 4 numbers: state tax, Medicare IRMA, the widow's single filer rules, and the 2028 sunset. That's the whole plan, nothing more. Here's the line I want you to remember. Write it down, screenshot it, tell your spouse over dinner tonight. The tax code doesn't reward the highest earner. It rewards the smartest organizer. If someone you love is paying tax on dividend income they don't need to pay, share this video with them right now. It could save them thousands a year, and it's information they may have never been told before. Before you go, I want to hear from you in the comments. What year are you planning to retire? And have you started building your Roth IRA balance yet? Drop your answer below. I read them all. And if you're serious about retirement income and you want to stay ahead of changes that can protect or cost you real money, hit subscribe. I cover this ground every week. Taxes, dividends, Social Security, and Medicare, all aimed at people over 50 who want to keep what they've earned. Next video, I'm going to break down the Roth conversion ladder, how much to convert each year, when to stop, and how to avoid pushing yourself into an IRMA bracket while you're doing it. You won't want to miss it. See you in the next one.